Okay, welcome back, members and ladies and gentlemen. So the second part, we have two speakers on the stage. Let me introduce. On my left is Mrs. Karen K.K. Ho. Mrs. Ho is a Deputy Principal Solicitor, Company Law Reform from the Company Registry, and her main duty is to assist in the rewrite of the Companies Ordinance. And I also got Mrs. Christine Francis Sitt. She is on the far left, and she is the Senior Solicitor, Company Law Reform of Company Registry, and her main duty is also to assist in the rewrite of the Companies Ordinance. So our two speakers will give us the presentation in this second session. So may I request Christine to start first? Thank you.
Okay, thank you. Good afternoon, ladies and gentlemen. Just now, my colleague Phyllis McKenna has dealt with the earlier parts of the new Companies Ordinance, and Karen and I will be dealing with the latter parts of the new Companies Ordinance, beginning with Part 9. Part 9 is on the accounts and audit provisions and on related provisions in Part 12, which is about company administration and procedure. Quite different from what Phyllis has just told you, the provisions on Part 9 in relation to financial statements and reports apply to a financial year beginning on or after the commencement of the new CO. These provisions include the requirements in relation to simplified reporting, the preparation of financial statements, director's report, laying financial statements and reports before an AGM, preparation of summary financial report, etc. And these provisions apply to a financial year that begins on or after the commencement date of the new CO. For the equivalent CO provisions that apply in relation to accounts, director's report, and summary financial reports, they continue to apply to a financial year beginning before the commencement of the new CO, and they also apply to a financial year that straddles the commencement date. Section 379 of the new CO provides that a company's directors must prepare financial statements for each financial year. Under Section 2, subsection 1 of Cap 32, financial year is defined as the period in respect of which the accounts are required to be made up and laid every year, which is the made-up date of the accounts. But under the new CO, Section 367 provides for the determination of a company's first financial year and the subsequent financial years by reference to a company's first accounting reference period. The financial year and the accounting reference period is the period by reference to which the company's financial statements are to be prepared. The company's first financial year after the commencement of the new CO begins on the first day of its first accounting reference period and ends on the last day of that period. So what is the first accounting reference period then? For an existing company, the first accounting reference period begins on the date immediately following the end date of the company's accounts for the straddling financial year. So for simplicity, we will just call this the end date of the accounts for the straddling financial year. And the first accounting reference period ends on the first anniversary of that end date. So if we take a look at the example on the next slide, assuming that the commencement date of the new CO takes place on the 3rd of March 2014, for Company A, the company's current financial year begins on the 1st of April 2013 to 31st March 2014. We call this the straddling financial year. And the end date of the company's accounts is on the 31st of March 2014. So under the new CO, the company's first accounting reference period begins on the 1st of April 2014 and it ends on the 31st of March 2015. This is the first financial year under the CO to which the new provisions on preparation of financial statements and directors' reports apply. For the second example, for Company B, the company's current financial year begins on the 1st of January 2014 and it ends on the 31st of December 2014. The end date of this so-called straddling financial year is the 31st of December 2014, and the company's first accounting reference period under the new CO is from the 1st of January 2015 to the 31st of December 2015. So the new provisions in the new CO in relation to the preparation of accounts will apply to that financial year. We have talked about the situation of existing companies. So what about the situation of companies formed under the new CO? For such companies, the first accounting reference period begins on the incorporation date of the company and ends on either a date specified by the directors falling within 18 months after the company's incorporation, or if the directors have not specified a date, it ends on the last day of the month of the first anniversary of the company's incorporation. This is the so-called default date. Obviously, directors should specify the end date before the default date kicks in. So for a new company formed under the new ordinance, the new CO provisions immediately apply to the first financial year of such a company. We have talked about the first financial year. What about subsequent accounting reference periods, which is the same as financial year? Well, under the new CO section 368, unless the accounting reference period is shortened or expanded, every subsequent accounting reference period is a period of 12 months beginning immediately after the end of the previous accounting reference period and ending on the company's accounting reference date. So what is the accounting reference date? For an existing company, the accounting reference date is the anniversary of the end date of the company's accounts for the straddling financial year. So if we look back at the slide that I previously showed you, for Company A, the end date of the accounts is 31st March 2014. The subsequent accounting reference period of Company A begins on the 1st of April 2015 and ends on the 31st of March 2016. So there's no change in the financial year concerned. For a company that is formed under the new CO, the accounting reference date is the anniversary of the date determined by the directors or the default date that I just mentioned. And again, for this new company, the financial year of the company is not changed. I will now talk about some of the changes in the requirements for financial statements and reports. The new provisions on financial statements are contained in sections 379 to 387 and Schedule 4 of the new CO. Basically, some of the terminologies have to be changed to align with the terminologies used in the Financial Reporting Standards and the UK Companies Act 2006. For example, under Cap 32, the word accounts will be changed to financial statements, and you can see examples of this usage in sections 357 and 379. For group accounts, it will be called consolidated financial statements or consolidated statements. For balance sheet, it will be called statement of financial position. For profit and loss account, they will be called statement of comprehensive income. And books of account will become accounting records. And also to align with accounting and auditing provisions with the Hong Kong Financial Reporting Standards, the requirement for accounts to comply with the 10th and 11th schedules to CAP 32 is repealed. Rather, financial statements are required to comply with reporting standards issued or specified by the Hong Kong Institute of Certified Public Accountants under the Companies Accounting Standards Prescribed Body Regulation. This is a new regulation made under the new CO. The accounting disclosures in Schedule 4 to the new CO will replace the detailed requirements in the 10th and the 11th schedules to CAP 32. As regards information on directors' emoluments, they are required to be contained in the notes to the financial statements, and this requirement is stated in Section 383. The detailed prescribed disclosures are set out in the company's disclosure of information about benefits of directors regulation instead of in the main ordinance. With regard to directors' report, the new provisions are contained in sections 388 to 391. There will be a new requirement to include a business review in the director's report, but there will be certain exemptions for this requirement. The detailed provisions on the business review will be set out in Schedule 5, and some of the exemptions include a wholly owned subsidiary and also companies that prepare simplified accounts. So for these exempted companies, they will not be required to prepare a business review. For larger companies, they can also be exempted if the company passes a special resolution not to prepare a business review. Other prescribed disclosures in relation to a director's report will be contained in the company's director's report regulation. Currently, they are set out in the main ordinance in Section 129 capital D. But under the new CO, these detailed and technical requirements will be set out in a regulation instead. Some of the new requirements contained in this regulation is that it should be information on equity-linked agreements should have to be disclosed, and also directors' reasons for resignation or refusal to stand for re-election also have to be disclosed in the director's report. On auditor's report, there is no major change on the contents of the reports, but there is a new requirement for the auditor's report to be signed, and this is set out in Section 409. The new provisions on auditor's report are contained in Sections 405 to 409, and there are other provisions in relation to auditors' rights, which are set out in Sections 411, 412, and 575. I would like to take this opportunity to introduce you a new term called reporting documents, which is used in Part 9 to describe financial statements, director's report, and auditor's report on the financial statements. This term will be used in provisions where there is a requirement to lay those statements and reports at an AGM or to send them to the members. And examples of these provisions that contains this term is Section 429 and 430. Under the new ordinance, the summary financial provisions will be revamped. Currently, they only apply to listed companies, but under the new CO, they are extended to all companies except those that prepare simplified accounts. Unless prohibited, companies have a choice of sending to its members a copy of the summary financial report instead of a copy of the financial statements and reports from which the summary financial report is derived. A new regulation called the Companies Summary Financial Reports Regulation will replace the current Companies Summary Financial Reports of Listed Companies Regulation, but in substance they are quite similar. Next, on the voluntary revision of financial statements and reports, again, there are no major changes, but the regulation that governs the revision will be renamed as Companies Revision of Financial Statements and Reports Regulation, which replace the Companies Revision of Accounts and Reports Regulation. I will now go into a new area, which is simplified reporting. Under Section 141 capital D of Cap 32, a private company, other than a company which is a member of a corporate group, and certain companies specifically excluded, may, with the written agreement with all the shareholders, prepare simplified accounts and directors' report in respect of one financial year at a time. Under the new CO, private or guarantee companies, other than certain companies specifically excluded, that qualify for simplified reporting are referred to as companies falling within the reporting exemption. And the detailed provisions in relation to such exemptions are set out in Division 2 of Part 9 and Schedule 3 of the new CO. There are a few types of companies that are qualified for the reporting exemption, and I will go through these with you now. Firstly, a small private company or a holding company of a group of small private companies meeting two of the following conditions in a financial year are qualified for simplified reporting or for the reporting exemption. Those conditions are companies that have a total revenue not exceeding 100 million, total assets not exceeding 100 million, and average employees not exceeding 100. Another type of company that is qualified for the reporting exemption is an eligible private company or a holding company of a group of eligible private companies meeting a higher size criteria. That is, with a total revenue not exceeding 200 million, total assets not exceeding 200 million, and average employees not more than 100. There is an additional requirement that there should be a 75% approval from the members and no objection from the remaining members. The resolution in support of this election should be delivered to the registrar for registration within 15 days, and that this requirement is contained in Section 622, subsection 1F and subsection 2. Another type of company that is also qualified is other private companies not being a member of the corporate group, who has also passed a unanimous agreement to opt for this simplified reporting. This is based on the current Section 141D of Cap 32. Similarly, a copy of the agreement is required to be delivered to the registrar for registration within 15 days. The requirement is also set out in Section 622, subsection 1E and subsection 2. Finally, a small guarantee company or a holding company of a group of small guarantee companies with a total revenue of not exceeding 25 million in a financial year is also qualified for simplified reporting. Next is the question of in which financial year you have to look at the size of the company in order to determine whether it is qualified for simplified reporting. If you want to qualify for simplified reporting in the first financial year of the company after the commencement of the new CO, then if you are an existing company, you have to look at the size of the company in the first financial year after the commencement or the straddling financial year. And if you are a new company formed under the new CO, you have to look at the size of the company in its first financial year. Once you meet the criteria for simplified reporting, you are qualified to prepare simplified accounts for that year and for subsequent financial years until you are disqualified. And disqualification kicks in if the company has not satisfied the qualifying conditions for 2 consecutive years. Then from the 3rd year onwards, the company is disqualified for preparing simplified accounts. So what happens if a company wants to qualify for simplified reporting in subsequent financial years? A company has to fall within the size criteria for 2 consecutive financial years before it would qualify for the reporting exemption for the financial year immediately following those 2 years. Similarly, qualification, once obtained, continues for the subsequent financial years until the company is disqualified. So we've been talking a lot about reporting exemption. What exactly is the exemption? For the avoidance of doubt, it is not an exemption of audit. Exemption from audit only applies to a dormant company. For the exemptions that apply are actually in respect of the specific requirements relating to the preparation of financial statements, the director's report, and the auditor's report. So, for instance, there's no requirement to disclose the auditor's remuneration in the financial statements, and there is no requirement for the financial statements to give a true and fair view. There's no requirement to disclose in the notes to financial statements the material interests of directors in transactions, arrangements, or contracts of significance entered into by the company. Subsidiary undertakings may be excluded from the consolidated financial statements in accordance with applicable accounting standards. There's no requirement to include in the director's report a business review or a statement in relation to arrangements to enable directors to acquire benefits by the acquisition of shares or debentures. There is also no requirement to disclose the amount of donations made by the company, the director's reasons for resignation or refusal to stand for re-election, or the particulars of material interests of directors in transactions, arrangements, or contracts of significance entered into by a specified undertaking of the company. There is no requirement for the auditor to express a true and fair opinion on the financial statements, and the financial statements may be prepared in compliance with the small and medium-sized entity financial reporting standard and financial reporting framework issued or specified by the HKICPA. So once again, reporting exemption, companies that fall within the reporting exemption are not exempted from audit of financial statements. Audit is still required for all companies except dormant companies. So now I'll pass the mic over to Karen, who will finish the rest of the presentation.